All right, welcome back, everybody. I'll finish up my slides relatively quickly, and then I will pass it off to Ms. Bridget. So, quick graphical or picture overview here of the two different proposals. So as a recap, the financial option will co-optimize energy ancillary services and the new imbalance reserve product, and we'll do that clearing off of bid-in supply, cleared bid-in supply. So you can see here I've grayed out the CAISO forecast because that does not have a role in this approach and where we are procuring the imbalance reserve product. So in this case, we'll be able to meet that uncertainty band in the upward direction with imbalance reserves up, and then we'll also be able to meet the bottom of the uncertainty envelope with imbalance reserves down. In comparison, the financial plus forecast option will also co-optimize energy ancillary services and imbalance reserves, but it will do that based on the combination of bid and supply and the CAISO forecast. You note here the major distinction is the orange chunk in the middle. That is what we will do to ensure the CAISO can meet the difference between cleared bid and supply and the CAISO forecast, and we will do that with the reliability capacity in the upward or the downward direction. In this case, we're showing it as reliability capacity up, which ensures we have a deliverable product to be able to meet the CAISO forecast. As a reminder, I talked on this at the beginning of the presentation, but it's important to note that regardless of what option we move forward with, our operators still need to exceptionally dispatch. As Bridget will show it here in a moment, we plan on procuring the new imbalance reserve product to meet the 95th percentile of potential uncertainty that could materialize. Well, P95 is great, but what about that extra 5%? That would be too much, we think, to procure on a daily basis. But in order to meet that 5%, that anomaly situation, you have a fire that comes, you have a transmission outage, something going on in the grid, the operators will still always need the ability to exceptionally dispatch. And in addition to that, we want to make sure we can meet the 15-minute ramp constraints. This is something we talked about last time. We know we have an hourly product. The day ahead is staying in hourly granularity. So we want to be able to run some type of tool to make sure that if we have steep ramping needs between intervals, that we can meet those. So both options will include an aftermarket reliability tool. We do not anticipate that this would be used regularly, but it would be there to inform the operators if an exceptional dispatch was needed to meet those abnormal system conditions or very steep ramping needs. And that's all I have. I guess we could have wrapped that up before lunch. Okay, we will take the question on the phone.
Okay, Lauren, we'll go to the question on the phone, please.
Hi, good afternoon, Megan. It's Mark Holman with PowerX. I'm wondering if we could just back up to slide 18, and I had a handful of thoughts before we move into the next section. So where you describe—
You want to go all the way to slide 18?
Yes, the one right before lunch. We didn't go to the phones right before lunch, so I just wanted to come back to this. So I wanted to make a couple of pieces that I understand you're calling it financial plus forecast, but the status quo and option ones is really virtual demand and virtual supply determining the market outcome, not just for energy, but for capacity commitments on a day-ahead basis. And option two is allowing virtual demand and supply to continue to play a role on energy, but having the capacity be decided by a CAISO forecast with physical resources contributing to capacity. So I think status quo in option one is very different than option two. The first point I wanted to make is that, again, we talked before lunch about the concept and potential of an EDAM. Again, I understand that virtual bids, virtual demand, and virtual supply are in the CAISO market, in the CAISO BAA, and they're part of an RTO construct. But this is having financial speculators determine unit commitment potentially across the West. And we see that to be a very difficult concept to apply to a voluntary day-ahead market across the West. So, for example, if you have a day-ahead market solution where you have net virtual supply, speculators, putting in convergence bids, virtual bids of 3,000 megawatts, that could decommit up to 3,000 megawatts of other people's gas or thermal generation elsewhere in the West, and then you'd be reliant upon the CAISO's ROC or exceptional dispatch to try to maintain reliability. Now, that's not to criticize virtual bidding, because we think it has a role under option 2, but I don't think that the characterization of these options is quite accurate. I think option 2, it is financial for energy, but it is physical for capacity. And I think George Angelides described it right. Option 2 is a much more efficient framework for procuring the right amount of physical capacity, including imbalance reserves, through a co-optimized approach, not just co-optimizing ancillary services and imbalance, but making sure you get the right level of physical capacity. So again, I think our first point is that we're really struggling with how the status quo or option 1 could work for an EDAM, where financial speculation is determining unit commitment in Arizona, Nevada, Washington, Oregon, Idaho, et cetera, that just seems, and I think you saw that from stakeholder feedback. The second piece I wanted to talk about was just that we do see that the current process of getting these balancing reserves through exceptional dispatch, RUC, and load biasing, as well as doing it through option 1, has systemic market design flaws in it. In particular, we see that what's happening is virtual supply over the last 5 years in the CAISO market has made, not just winners and losers, but on a net basis, has made about $160 million in profit off of ratepayers. And part of that is because virtual supply is getting rewarded by not bearing the losses when they get the supply wrong, because this exceptional dispatch, RUCnet short and load biasing, adds additional supply, and they don't bear the consequence. So we're seeing that this virtual supply, virtual demand, while we think it can have a valuable market efficiency role in option 2, we don't see it palatable for the rest of the West under either the status quo or option 1. And we think even for the CAISO BAA, there is a problem that has not yet been identified, which is the CAISO's out-of-market actions are generating systemic profits for virtual supply. They've been growing in recent years. In 2018, I believe the net profit was $55 million. That's going to continue to grow if you have out-of-market exceptional dispatch load biasing that ends up providing virtual supply a safety backstop that they don't bear losses because additional supply is added out of market. So I'll pause there and hear your thoughts and comments.
Yeah, I know Don wants to chime in too, and this will be a part of his discussion. It's okay, Don. But I think some good points, Mark. I think another way to think about it, though, when I think about the difference between option 1 and 2, which I think you're getting at, is option 2 is actually pulling the forecast in. And we thought about that as the benefit and how option 2 would work. But I think one of the conflicting or opposite sides is if you think about option 1 under the EDAM structure, that would be allowing EIM balancing authority areas to determine how they want to position their fleet based on the needs they think they have, take a financial position. Under option 2, it would be forcing the CAISO's assumption of what the forecast would be into that paradigm. So it's just a difference. It's a shifting thought process from today having the day-ahead market be financial and allowing load-serving entities to take a position. I don't see it as a speculative position. I see it as a financial position that the load-serving entities can say they want to schedule X amount of generation and supply. And that would change under option 2 when the CAISO's forecast plays a role in that. And that would also be hoping that the CAISO's forecast is more accurate than what the load-serving entities think or are scheduling their resources today. So it's a total paradigm shift moving towards option 2.
So I will say that one thing I'll point out is that for virtual bids, about 70 or 80% of them are by financial entities. I will describe that both option 1 and option 2, load-serving entities both get a role in determining how much energy to procure under both option 1 and option 2. The difference being that in option 2, like the EIM resource sufficiency test, you cannot have each entity decide how much capacity to commit, because in an EDAM construct, if somebody goes short capacity, like let's say the CAISO BA or another BA because they have virtual supply or not enough bid in demand, that reliability risk gets socialized to other entities who end up decommitting their units because they think the other BAs in the EDAM have sufficient capacity committed. So when we're talking about capacity commitments, we need to ensure there is sufficient physical capacity commitments, not put that in the hand of saying, hey, we got to just trust each other that we'll get it right, including financial speculators, and then deal with exceptional dispatch and out of other market actions to make up the difference. Again, recognizing we're not in an RTO and an EDAM. A lot of the supply is voluntary. If you can't find that voluntary supply after other BAs have decommitted their units because the CAISO had 3,000 or 4,000 megawatts of virtual supply clear the market, who bears that? Who bears the reliability risk of that?
Yeah, and I think it'll be good to get to the case studies. For those of you who have jumped ahead in the presentation, we have 4 different case studies showing 4 very different days of actual net loads on the system. And I think that will help play out different scenarios because there are some strange scenarios where if our 15-minute net load comes in higher than the day-ahead market, we can actually, through virtual supply, in option 2, prohibit actual firm generation from being committed, which could be problematic. So I want to wait for the case studies. I think this is a good preface, Mark, and I appreciate you bringing up these points because I see this as the value of today's meeting and really understanding the differences between the 2 options and getting back to what Carrie mentioned earlier, thinking about the purpose of our day-ahead market and what purpose does it serve today, what is the purpose of IFM, what is the purpose of RUC, and what do those become when we move into tomorrow. So I appreciate you bringing these points up.
I appreciate it. Thank you very much.
Go ahead, Paul.
Paul Grivick, PG&E. I guess I have a bit of a question. I'm a little confused about some of the diagrams you have in this section. The way I understood what was being proposed in the past and a little later, the imbalance reserve up requirement and the imbalance reserve down requirement on a given day is set regardless of what the ISO's forecast is or what clears in the day-ahead market. That is set before the market is run. So those bands, like on page 28, the band for the imbalance reserve up and the imbalance reserve down, I believe that block is set before the market's run, and therefore you actually have 2 potentials here. One is imbalance reserve up when considered with respect to the CAISO forecast, imbalance reserve down. So that green thing could be centered around the CAISO forecast, and it could also be centered around the cleared bid and supply. And given what George said before, I think both are being considered. So I think that this might be a little confusing in that the imbalance reserve up and imbalance reserve down requirement is set before the market, and then the market considers, okay, whenever I'm clearing, let me consider it around the forecast and around the cleared supply.
Glad you brought that up because we actually discussed this internally. That was originally what was going through my mind as well. But as we've moved forward, we actually are indicating here that we'd be defining the upward target. Let's call that a megawatt number, and a downward target a megawatt number. So this actually would not, the envelope wouldn't necessarily be shifting around. Let's assume the envelope is 5,000 megawatts. It wouldn't necessarily shift up or down. It would just be the amount of up and the amount of down relative to cleared bid and supply or relative to ISO forecast.
Again, that means that that green block moving up and down, because if my forecast is raised by 100 megawatts, the up and down block is moving with it.
If your forecast was raised by 100 megawatts, that would just mean in option 2 you're buying 100 megawatts less of imbalance reserves and 100 megawatts more of imbalance reserves down.
I don't see that in your formulations. You're saying the sum of my imbalance reserve that I'm buying has to be greater or equal to my imbalance reserve up requirement. Nowhere is the CAISO forecast or the cleared supply showing up in that constraint.
Go ahead, George.
Yeah. So the imbalance reserve requirement and also the requirement for the reliability capacity, because now you have two products with this option. Essentially, the imbalance reserve from option 1 is here procured as two pieces. So this is a little bit more precise. It separates uncertainty from the error in the demand forecast between where the financial market clears and the demand forecast is. But the fact of the matter is that these are relative capacity requirements, and in the formulation that we proposed, this is relative with respect to a schedule, and we have a dual constraint that we make sure that if you consider the financial energy schedule as the reference or the demand forecast as a reference, we make sure that it works under both scenarios. The idea was that we don't know who has it right, whether the financial market has it right or the ISO has it right. Whatever we procure for imbalance and reliability capacity, we want to be deliverable on either outcomes.
Yeah, no, I think that I understand what you just said, but that doesn't seem to be what's drawn here, and that's why I'm a little confused, because this looks to me like your imbalance reserve up and down is an absolute megawatt number on your total scale, as opposed to a band around what you've cleared or what your forecast is.
Right. Thank you for bringing it up, Paul. I think it's an important clarification. It is a relative capacity requirement, so it is a band relative to what point you consider to be the reference, and to be on the safe side in this approach, we consider both points as reference to make sure that we're under both scenarios of feasible outcome.
Okay, I think I understand what you're saying now. Like I said, wherever I was going through this, I was getting confused. I thought that something was shifting, and I didn't see the math following the shift. So thanks.
All right. Oh, go ahead. Sorry.
Hi, Lindsay Schluckaway from NV Energy. I have two questions. The first one was to clarify what you stated about option 1 for the EIM, if it was extended to day ahead. So you're basically stating that in your, eyes of this design, that option 1 would allow the EIM entities to use their own forecast for day ahead rather than CAISO. Correct. Okay. And then my second question is for slide 29.
There's one caveat to that. It's not a forecast, it's a bid. So it's whatever you bid. So if you self-scheduled a map quantity, then it would be the same as a forecast.
Yeah, I think he's referring to the demand forecast for the formulation here. So for option, were you asking for option 1 or for option 2?
Option 1.
For option 1.
For option 1, the forecast doesn't matter. It's what you bid.
Okay.
They can bid whatever they want.
So you could choose to bid your forecast.
Okay.
Or you could choose to come in short or long. You get to make that financial determination based on your bids, as opposed to clearing relative to what the CAISO's forecast is for your BA.
Okay.
But thank you for the question, because it's important also to discuss what happens in option 2 with respect to demand forecast. There was a statement that was made that you don't want the ISO demand forecast to really drive the capacity requirements. So there's also a caveat here. We have a process where we can use, instead of the ISO's demand forecast for a certain EIM entity, balancing authority area, we can use their own forecast if it can be proven from historical data that they can forecast their area more accurately than the ISO, and we're doing that today in the EIM. So I expect that we will be open to that idea also in EDM.
Okay. Okay, thanks for the clarification. Okay, my second question is on slide 29. Okay, so here you're showing that the exceptional dispatch is essentially changing the imbalance reserve product. Is that correct? It changes the capacity?
Thank you for bringing that up. No, it does not. So I tried to indicate that with the different colors. So the red is additional energy schedules to meet the operational need. So it would not be the exceptional dispatch of additional imbalance reserves. It would be an exceptional dispatch to have additional energy scheduled.
And let's clarify this a little bit as well. The practice for the exceptional dispatch in this case is to focus on exceptional startup for long start units, the ones that you don't have the ability to start in real time. So yes, there will be also energy schedule, but we don't care about that 1 day ahead of the time in terms of exceptional dispatch instructions. All we want is to make sure to position the units so that then the real-time market can actually dispatch them wherever they need to be. But we don't have the ability to do that with the real-time market when it comes to starting up long start units. So out of that red arrow that you see there, we're only focusing on what long start unit needs to start. And the exceptional dispatch instruction will be just starting up those long start units.
Okay. All right. Thank you.
This is Mike Castellano from Energy Division. So if you still need exceptional dispatch to start long start units, then what are we getting out of the imbalance reserve? I thought what we were getting out of the imbalance reserve was making long start units and imports available to the real-time market.
Thank you, Mike. You want to answer this?
Yeah. So I think you might have missed this a second ago, but the important thing is the takeaway at the bottom of the box, right? If our imbalance reserves are covering the majority of our abnormal situations, we don't want to buy the product. We could procure 100% of the uncertainty that we've seen materialize over the last year. That would be too much. That would be too expensive. So assuming we procure at P95, 95% of the uncertainty that can materialize, we still need a process for our operators to procure additional energy and schedule additional energy if that absolute worst case scenario happens, or if something happens between the day ahead market and when this ED occurs. We have fires, we have real-time outages, and if we need to ED, still have to allow the operators the ability to do that, and that's all this slide is indicating.
And let me add something to that, Mike, as well. As you know, the day-ahead market produces hourly schedules, but the real-time market that we're targeting for with the imbalance reserve product is a 15-minute market. So there is also the granularity aspect. So even if this extreme uncertainty out of the P95 margins does not materialize, or there are no outages, there may still be a reason when you check the feasibility of the hourly schedules at the 15-minute interval increment, there may still be a reason that you will need to start up a long start resources to shuffle your commitment to address that scenario. So this is another reason why there may still be a need for exceptional dispatch instructions, but the statement here is that there will be less frequent than when you don't have the imbalance reserve product that covers 95% of your needs.
Okay, so just from what you just said, George, is there actually like a process that you guys are going to design to look at the 15-minute ramping needs and determine whether you need to exceptionally dispatch?
We're considering that.
Okay.
Is there any reason why you say you need like 95, like P95 as the, you know?
Good question. So Bridget's going to talk about that. Bridget's background is in statistics. So she'll show the numbers and then talk about why, from a statistical standpoint, P95 is appropriate and how that correlates to the numbers we've seen. It sounds like we've got one more question. Oh, let's take the one on the phone,
go ahead
and then we'll come back to you.
I have one more question.
Oh, okay. We'll take the question in the room, and then we'll go to the phone. Thank you. Go ahead.
Okay. Based on your option 2, basically you have 2 energy schedules. One scheduled along bidding demand. The other one is along with the low ISO forecast. But for these 2 energy schedules, which one applied to the transmission constraints?
The second one, so the energy schedules that would be used to meet the difference between the cleared bid and demand and the CAISO forecast.
Okay, actually, Megan, the proposed formulation has transmission constraints both for the financial energy schedules and for what we call reliability energy schedules, which is the financial energy schedule plus reliability capacity up or minus reliability capacity down. So we make sure that we have a feasible outcome, again, irrespective of who gets it right. So if the financial market is right, the outcome is feasible. If the ISO demand forecast is right, the outcome is again feasible. So you have, this is the effect that you get from co-optimizing both aspects of FIFM and RAC under one optimization market umbrella. We make sure that the outcome is feasible under both scenarios.
I'm not sure whether I'm understanding it correctly. Basically, for each constraints, transmission constraints, you're going to have two formulas associated with that transmission constraints, right?
Yes, you have transmission constraints with respect to the financial energy schedules and transmission constraints with respect to the reliability energy schedules. Your network is the same, so the concept of the shift factor is the same because it's the same network, but the effect of one schedule versus the other on congestion and transmission congestion could be different, and we make sure that you won't have transmission violations under both scenarios.
Okay, then one more. Which share price is going to be applied to the settlement?
So you have a settlement for financial energy schedules at the LMP, which is calculated from the financial constraints in the problem, which is your power balance constraint and any binding transmission constraint with the financial energy schedules. That is used for compensating financial energy schedules. And then you have another LMP from the other side of the problem, from the power balance constraint of the reliability energy schedules and the transmission constraints that are binding with the reliability energy schedules, and that is used to compensate for the reliability energy schedules.
Yeah, then which one is for the CRR, the reference?
So the proposal for CRR is to stay within the confines of the financial energy market. So it's the LMP that is used for remunerating financial energy schedules.
Question here. Sorry, just jumping back to slide, Andrew Meditz with SMUD. Slide 26, sorry for going backwards again. I was looking at this. The last bullet point, is the VER forecast the ISOs or is it the generators? That was the ISO forecast as well? Okay. Thank you.
By the way, this is exactly the same process that we're using in today's RAC. When we clear RAC, we're using the ISO's VER forecast, not what VER cleared the market. So it's exactly the same.
So, Lauren, we'll go ahead and take the question on the phone now, please.
Hi, it's Mark Malone with PowerX. I just wanted to touch on, if you could just go back to the graphic. I think I see a gap here on the financial approach with the imbalance reserve product, and really want to hear your thoughts, particularly, how George has thought this through. But I guess the problem I'm struggling with is, and let's just use a numeric example. Let's say we have 40,000 megawatts of load, forecast day ahead, 40,000 clears day ahead, 40,000 happens in real time. And let's say we have contingency reserves of 6%, so let's just call it 2,500 megawatts for rounding. So we have 40,000 megawatts of energy and 42,500 total when you include ancillary services that clears through the co-optimization. The same thing happens in real time. We get price convergence. If I understand the proposal correctly, I think where the financial falls apart is that if you now procure, let's just use a round number, let's say you have to procure 2,000 megawatt of imbalance reserves up and 2,000 megawatts of imbalance reserves down, just for argument's sake, for simplicity. The imbalance reserves down will largely get held on units that are already producing energy, offering to reduce their production. But acquiring 2,000 more megawatts of imbalance reserves up that happens today through out of market and is causing that virtual bidding inefficiency we were discussing, that is going to raise the day-ahead market clearing price, because now instead of procuring 42,500, you're procuring 44,500 because you have to procure 40,000 megawatts of energy, 2,500 megawatts of contingency reserves, and 2,000 megawatts of imbalance reserves. So without the imbalance reserves being procured, you have a $40 price day ahead and a $40 price real time. But now that you're procuring imbalance reserves day ahead that you no longer need when you get to the FMM because they're covering day ahead to FMM uncertainty, now you're going to raise the day ahead clearing price, causing systemic price divergence between the day ahead and real time market. And virtual supply is going to come in and make profits off of that. And if virtual supply is perfectly efficient and perfectly competitive, what it will actually do is it'll come in and that virtual supply will come in at 2,000 megawatts and unwind the capacity that you just procured through imbalance reserves. It'll effectively nullify that as virtual supply attempts to converge the day-ahead energy price to the real-time energy price. So either virtual supply makes systemic profit, or it ends up unwinding the very same capacity commitment you're trying to achieve through the imbalance reserves up. That is one of the reasons why we see the financial, when you add imbalance reserves up, it no longer works for virtual bidding. You're going to create virtual bidding systemic profits, and you're going to unwind the capacity commitment created by the imbalance reserves up as convergence bids appropriately chase those price signals. And I think that's what causes the necessary price separation between virtuals and physicals in the modified approach to option 2 that we put forward in our comments, is that you actually allow physicals and virtuals price to diverge. That allows the energy prices to converge without unwinding the capacity commitment of your imbalance reserves. We are seeing that same phenomenon today, we believe, through the reports that DMM puts out annually. You can see that virtual supply is systemically making money because this additional supply is being added through exceptional dispatch, load biasing the HASP, RUC and RUC net short, that it creates systemic profit for virtual supply, and that's going to get expanded upon here through the financial option, through formally buying imbalance reserves if you went with status quo or option 1, and could get expanded across the West. So again, I think there's a gap here that if you're buying a higher bucket of reserves day ahead than real time, that forces you to separate out the physical from the financial.
Hi, Mark. This is George Angelidis. I saw. Good comment. I just want to add to it and maybe clarify the fact that the cost that you pay day ahead, the additional cost for the imbalance reserve that maybe you won't need in real time, is really a cost of insurance because you're insuring against that P95 uncertainty materializing in real time. And yes, it may not materialize. If it will not materialize, then your argument is correct. You're overinsured, so you're paying a little more in day ahead just to cover that P95 materializing in real time. And you make a good point about the virtuals. So I just want to say that under the option 2, we have a proposal, I believe, still in the technical paper there, of allocating costs for the reliability capacity to the causes for the need for the reliability capacity. So if you have costs for reliability capacity up, I believe we allocate that cost to virtual supply and demand under scheduling. So there are some mechanisms to, maybe it's not perfect, but there are some mechanisms in the proposal to take away some of these gains that you articulate that the virtual bidders may materialize in the day ahead because of the fact that occasionally will be overinsured.
George, I just want to talk about that because let's go back to my example because I think that was a valuable comment and I really want to make a couple of points. If you have a forecast in my example of 40,000, but we have plus or minus 2,000 megawatts of uncertainty, so it could be 2,000 megawatts higher, 2,000 megawatts lower. Because the down reserves is generally going to be held by decking resources that have energy awards and have the ability to go down towards their P-min, but the up reserves looks like additional spin or non-spin. You're now raising the overall clearing price. It's going to cause this systemic price divergence. And on average, you are going to be back at 40,000, not 42,000. You're buying those just like you're buying contingency reserves. You're buying 2,000 up and 2,000 and down. You're going to increase the clearing price day ahead because of that 2,000 megawatts of up needs to now be procured. You need to buy 40,000 megs of energy, 2,500 megawatts of contingency reserves, and 2,000 megawatts of imbalance reserves. You now need to clear effectively 44,500 megawatts of supply. When you get to real time, what is very different between this imbalance reserve and the contingency reserves is that uncertainty's gone away. You still need 40,000 megawatts to serve load. You still need the 2,500 megawatts of contingency reserves, but you no longer need the 2,000 megawatts of imbalance reserves because the uncertainty has gone away, not like contingency reserves. And so your total procurement in the day-ahead market is a higher quantity than what you're doing in real time. Now, that's a problem that exists today with your out-of-market actions. This is more formalizing it. That's why we're seeing that $160 million in profits over the last 5 years in the CAISO markets for virtual bidding. We think that's one of the key causes of that, is that you're ending up over-procuring additional insurance day-ahead or through out-of-market that then is no longer needed in real time. Now, I think that option 2 is the only one that can address it. We gave detailed comments that talked about how to enhance option 2 to correctly include that imbalance reserves actually contribute to the capacity need, and those are in the equation, and to properly include VARs at their actual reliability capacity. So we would like to have further workshops discussing alternative formulations to your option 2, but we generally agree with the option 2 direction that you're going in and what you're describing, and we see option 1 frankly, is potentially fatally flawed because it's not recognizing this, and you're just going to either have virtual profits that are systemic and or they're going to unwind the very capacity commitment you're trying to make through the imbalance reserve product.
Okay, thank you, Mark. So we do need to move ahead. So we're going to get into the data analysis now. And we'll have... Okay, we'll take one more question, Mike. Yeah, we're falling behind here.
Well, but what Mark said was not really true, I don't think. I think, Mark, you're talking about virtuals trying to leverage the difference between, so that price difference you're talking about between day ahead and real time is not going to be a difference in energy prices, I don't think. It's going to be the cost of the imbalance reserves, which virtuals can't necessarily get. And if you talk about clearing 2,000 megawatts of virtual supply in the day ahead, you're going to have to do something with load. Price is going to have to move somewhere. That's presumably going to have to be bid differently. I think there's a lot more effects going on there than you're accounting for so far. And I think if you actually write that out, it won't be the problem that you're thinking it is.
We'd love to work that through, Mike, because I think what we're seeing is, and the best example is maybe contingency reserves. If you only procured energy day ahead, and let's say you had a subsequent process for contingency reserves, you would find that the day-ahead clearing price for energy is lower. Once you co-optimize energy and contingency reserves, because some units are now held to carry contingency reserves, you need to go further up the supply stack to get your bid-in amount of energy. The same is true for imbalance reserves. If you have 2,500 megawatts of contingency reserves that you need on units unloaded, and you have another 2,000 megawatts of upward imbalance reserves that needs to be on units unloaded, it raises the clearing price for energy because some of the units you would otherwise take for energy now get set aside for imbalance reserves, and it raises the clearing price. We very much understand that virtual bids seek to converge energy prices between the day-ahead and real-time market, but when you're doing the co-optimization, the more reserves you procure, the higher the clearing price will be for the other products, including energy. That works in a standard organized market design with virtual bids when your energy, your load forecast, your contingency reserves are not systemically different. You have the same amount of contingency reserves needed in real time, generally speaking, as you do day ahead. For imbalance reserves, you need these day ahead, and you no longer need that same quantity in real time. That is going to raise the day-ahead energy clearing price and cause systemic profits. And we really encourage further dialogue on this because when we look at the data and the great analysis that DMM has put out on this, we're seeing exactly that outcome from the data that virtual supply comes in and sells in the day-ahead market. And then if loads come in high, the CAISO exceptionally dispatches, load biases, RUCnet shorts. Understandably, we understand why the operators do that, but it adds additional supply into the FMM, causing virtual supply systemic profits. And now we're more formalizing this with the financial option. So again, I know we can't resolve all this here, but we really do think we need to flush this out because we are seeing a gap in the financial approach with imbalanced reserves.
Mark, just to add a little bit, and it doesn't take away from your point, just want to make sure that your example is accurate. We do have additional capacity procurement in the real time in FMM for the real-time uncertainty. Of course, that's much less than the amount that you will procure in the day ahead. But this is a mitigating factor, but still your point is understood.
Thank you, George. And I agree with you. The real-time reserves, if those are 500 megawatts that you buy in the FMM, but you're buying 2,000 day ahead, as you've already highlighted earlier, because it's a much greater amount of uncertainty, that difference is going to cause systemic profits, and or if virtual bids are perfectly efficient, it will unwind that extra 1,500 and you'll have bought reserves that are completely unwound through virtual supply.
Yeah. Mark, this is Khalid from California ISO. I think you're making a very good point. We would like to take it back, think about it. There is also the impacts of the uncertainty of the load, because once you procure the imbalanced energy in the day ahead, and if your energy itself in the real time also increase. So there's multiple factors that we would like to think about the example you brought up, and I think it's very important for the ISO to take it back and work out.
And I appreciate that. I want to let folks move forward. We have worked this through with a solver, and that's why we believe option 2 can actually maintain an important energy convergence role for virtual bids that option 1 cannot.
Okay, so this is Bridget Clark with the ISO. And so far we've been talking about uncertainty in more qualitative terms and are sort of assuming it based on the fact that we've seen an increase in RUC biasing and exceptional dispatches, but in stakeholder comments, there was a lot of desire for us to put a number on it and to kind of quantify the problem that we're talking about. And so the following analysis is an attempt to put a number on the problem we're talking about. There we go. Okay, so just so we're on the same page of what this analysis is going to show, so this analysis shows that uncertainty between day ahead and real-time market exists and is predictable to some degree. So data shows that net load uncertainty has increased over time, that this uncertainty varies seasonally and by hour, and that we can identify certain factors that help drive or predict the uncertainty that we observe. So factors like where load comes in, where the VERs are forecasted, what month we're talking about, what operating hour, and seasonal temperatures have a relationship to the amount of uncertainty that we observe historically. And so our idea is that then we can use these factors to then scale our procurement targets so that we could have a more efficient uncertainty band that we're procuring, and so we're better matching what the expected uncertainty is based on these factors and their relationship historically. So in order to do this, we performed various descriptive and statistical analysis. So first we're going to compare the correlations across net loads from each market run with the goal to try to understand which market is more closely aligned to real time. So is the IFM better at predicting what real-time load is, or is the CAISO forecast? Next, we're going to compare historical uncertainty between various market runs. And so, again, we're going to try and quantify what is the historical magnitude of uncertainty and has it changed over time. And finally, given these observations, we did statistical tests to show that these patterns aren't random, that there is some underlying relationship between these factors that is driving this observed uncertainty. And so therefore, if we can identify the factors, then we can then scale the requirement to better match future uncertainty. So just so we're all on the same page, When we talk about market cleared net load, what we're talking about is the cleared demand minus cleared net virtual supply minus cleared verse supply. So this is the IFM net load. Next, we look at the net load forecast. So this is the demand forecast minus the verse forecast, which we typically think of as the RUC net load. And then we have the adjusted net load forecast, which is that the net load forecast plus the operator adjustment, so plus that RUC net short number. And so these three numbers are measured on an hourly basis. And then the FMN net load is the 15-minute market demand forecast minus the 15-minute verse forecast. And so this is going to be on the 15-minute level. So this table shows the correlations across net loads for each market run. And so the first column, second row of 0.9485 shows the correlation between the market cleared net load and the forecast net load. And so the way to interpret these is to notice both the sign and then the magnitude of the number. So typically in statistics, we say that if this correlation is above 0.9, then it is strongly correlated with one another. And because it's positive, if market cleared net load is high, then the net load forecast will also be high. And then more importantly, though, is this bottom row highlighted in red. And so this compares each of the day-ahead net loads to the 15-minute net load. And what we want to see here is which of these numbers gets closest to 1, and 1 represents a perfect correlation. And so if you look across the day-ahead market that gets it closest to real-time most often based on correlation is the net load forecast of 0.9738 compared to 0.94 for the market cleared load and then 0.96 for the adjusted net load. And so this would lead us to predict that the uncertainty that would materialize between the day-ahead market and the real-time market would be smallest in the net load forecast or a RUC load. So we would expect to see that when we look ahead and quantify the magnitude of uncertainty, we would expect less uncertainty to materialize in the forecast than in the market. So next, so we all understand what we're talking about when we talk about uncertainty. So uncertainty is calculated by taking the FMM net load and then subtracting each day ahead net load. And so this is on a 15-minute interval. So it takes, so say for hour 1, for interval 1, it takes whatever the FMN net load was for hour 1, interval 1, and subtracts the hourly schedule for hour 1 to that number. And so uncertainty, to answer a question that was asked previously, is measured on a 15-minute basis rather than on an hourly basis. So within an hour, you could see 4 different numbers for uncertainty. And so the way that we interpret this, because we're subtracting the day-ahead net load from the 15-minute market, so when that value is negative, that indicates that the day-ahead market cleared higher than the 15-minute market, and this indicates a need for imbalance reserves down. And then if this number was calculated and it was a positive value, that indicates the day-ahead market cleared lower than the 15-minute market, and it demonstrates a need for imbalance reserves down. Any quick questions?
When you calculate the uncertain up and down, did you consider the cross-hour ramping? Because you said you compare the 50 minutes value to the hourly schedule, but basically from hour to hour, it's a ramping, right?
Yeah, so we just did a flat hour, and so we're talking about how to better quantify that ramp rate, and so hopefully in the next phase of the analysis, we'll be able to kind of speak more to what's really uncertainty and what's really the difference in the ramp.
So just one thing that occurs to me while we're looking at this, that the market cleared load is a behavioral outcome, and we don't necessarily know that if we were to change. So everything you're saying is relevant for what has happened in the past, but if we change the incentives, if we change the market, then, in order to say that these conclusions are going to be the same moving forward, we're assuming that no market participant is going to change their behavior, that, PG&E, SCE, everybody that bids load into the market wouldn't change their behavior in response to that change. So they would bid the same for load, even if there were all these other products in there, and if there were different implications to there being a difference between day-ahead and real-time.
No, I think you're right, Mike. I think to the extent that bid and demand caused the amount of imbalance reserves that you needed to buy to increase, there'd be incentives to not do that.
Okay, so we've compared the correlations across net loads, and then we want to see if, because the net loads are correlated with the uncertainty that materializes across the different market runs, would that also be correlated? And what we find is that is not the case. So if you look at the red box, which compares the uncertainty that materialized from the market net load to the forecast uncertainty, because it is below 0.5, there's a weak correlation there. And so just because the net loads across the day-ahead markets are correlated, that doesn't mean that the amount of uncertainty that materializes between the IFM and the FMM compared to the RUC to the FMM is the same. So those two numbers are different, is what this shows. Okay, so next we want to, again, put a number on the uncertainty envelope that we've been talking about. And so this table shows the annual trends in uncertainty. So uncertainty up is measured at the 97.5 percentile, and uncertainty down is measured at the 2.5 percentile. And so the full bars up and down will equal 95% of the distribution. So what we see here, as expected in 2017, market uncertainty was larger overall than what was materialized in the forecast and the adjusted forecast. So in 2017, we observed 2,600 megawatts of upward uncertainty and 3,100 megawatts of downward uncertainty, compared to around 2,600 megawatts in the forecasted uncertainty and around 1,800 megawatts of downward uncertainty for this forecast. And then looking at 2018, you can really see that this problem has been increasing over time. So we see a spike in market uncertainty. So in 2018, we observed around 3,200 megawatts of upward uncertainty and 3,400 megawatts of downward uncertainty. Again, our forecast uncertainty got it more correct because uncertainty band is smaller, so we observed a similar 2,600 megawatts of upward uncertainty and 1,600 megawatts of downward uncertainty. And then I think the purple bar, which shows you the adjusted forecast, so this includes that RUC net short, that operator bias, you can really see the inefficiencies that it's creating. So if you look at the downward bar from 2017 to 2018, it went from 1,800 megawatts of downward uncertainty to 2,700 megawatts of downward uncertainty. And so there's a huge spike in downward uncertainty caused by operators over-adjusting. And so this isn't presented here, but in 2017, there was around 2 to 3% of the time that operators were biasing, and in 2018, 17% of the time the operators were biasing. So you can see that increase in operator bias is being materialized in more downward uncertainty. And then this last bar is the first quarter of 2019, which is where our data set ends. Again, you can see that the market uncertainty remains larger than the forecast uncertainty, of around 3,400 megawatts of upward uncertainty and 2,800 megawatts of downward uncertainty. Again, your forecast uncertainty is similar. We expect this to grow, as I'll show later, that there's a seasonal trend, and so Q1 is our winter months, and our uncertainty is very different in spring and summer. So hopefully we can expand this to look at these last 2 quarters to see if we continue to see an increase, which I expect we will.
Hi, Lindsay Schluckway from NV Energy. I don't know if this is the appropriate time or not, but Will you be explaining why you believe the 95% is reasonable?
Yes. Yeah. So in the next 2 slides, I will talk about that. Okay.
Michael Colvin from Environmental Defense Fund. I appreciate how you aggregated 17 and 18, and you've done the best you can with the information we have for this year. Is there an annual variation an intra-year variation on how the uncertainty occurs? Do we see more uncertainty in certain months than others? Do we see it in more quarters than others?
Yes.
And so even if we were to take Q1 of 2018 to Q1 2019 to make a more apples-to-apples comparison, the uncertainty rate, even controlling for that, still seems larger, that the uncertainty trend is growing.
Yes.
Okay. Do you have a sense by how much?
Not off the top of my head. I can go back through and do that, but I can tell you in the regression results, the year is a significant factor. And so robust at all the controls, there is a yearly trend. Yeah, and a seasonal result.
The seasonal is mostly what I was aiming for.
Yeah, so in a couple of slides, I'll also go over the seasonal trends.
Cool.
Wait. Yeah.
It's Dan Williams from Customized Energy Solutions. It would be nice, and I think Carl's not here anymore, but to maybe map that over to the flexible capacity needs assessment and to look out at, compare numbers for 17 and 18 out of there and then graph that forward out to 2021, 2022, and maybe extrapolate how you would expect these uncertainty trends to grow if the trends in overall flexible ramping need continue to grow as driven by, solar build-out, et cetera.
But Dan, I would note that this is just the uncertainty portion of the flexibility requirement. Remember, there's a 1-hour ramp and a 3-hour ramp as well. So this would just be the uncertainty portion.
Yeah, I was just thinking as a marker for the size of the growth over time.
Eric Fair, Respondable Power. Those numbers are average. Do the P95 average over the course of the whole year?
So this is for 2017, it's all of the data in 2017, and it's the value. Distribution of that. Okay, so these next 3 slides show the full distribution of the annual trends. And this is for 2017, and this is kind of showing you where those bars came from, and then also seeing sort of other parts of the distribution. And so here, an interesting thing to take note of is the 50th percentile, which is the median. For the market uncertainty, it was 208 megawatts. For forecast uncertainty, it was 192, as well as for the adjusted forecast. And so this is showing on a regular basis, we are coming in short to the real time because it's positive, and so we're needing more upward capacity. But I think I want to spend more time on 2018, and so again, this is the full distribution. Again, we see the 50th percentile is positive, and so majority of the time we are needing more upward capacity. But to really answer that question of why we want to procure at the 95th percentile, so if you look here, comparing the 99th percentile and the 97.5 percentile, for the market, that was 800 more megawatts of upward capacity that would have been needed to cover that 1.5%. If you look at the downward direction for the market, you would have needed another 900 megawatts of downward capacity. And so to the points that have been made, procuring on average another 1,700 megawatts on a daily basis to cover this extra 3% of uncertainty is going to be really expensive. And so, I mean, it's an open question. If you guys want to procure that, you can. But in my mind, it seems to be excessive for the 2 to 3% chance that you might need it on 100% of the time you're procuring that extra 1,700 megawatts. Additionally, 95th percentile is a common metric that in statistics we use to balance the likelihood of making a type 1 versus type 2 error, and so kind of balancing the chances of you making the wrong conclusion. And so 95% is, again, common metric. It's procuring enough of the worst case scenario without overdoing it. And additionally, when we observe uncertainty, we're usually only off in one direction. So we're either going to be needing more uncertainty up for the whole day or more uncertainty down for the whole day. And so in actuality, you're really only going to not be covering 2.5% of the possible uncertainty versus the full 5%. Because again, when we observe uncertainty, it's usually only in one direction. And so in our minds, it's better to let exceptional dispatch cover the 1 or 2% of the time that our imbalance reserve product isn't meeting the full amount of potential uncertainty. Yeah.
It's Mike Castellano, Energy Division. So two things. One, I think at some point we had talked about using a sort of what do you call it, like a demand curve for this, hadn't we, where you could sort of incorporate this. Don is saying yes, George is saying no.
Not in the day ahead.
Okay, but I mean, it would theoretically be possible to put in some kind of stepped parameters in here so that if it was, instead of making a hard line decision sort of beforehand, we could say, okay, when, it's not going to cost more than X amount, it might be worthwhile to procure more, et cetera.
Well, all this will do, Mike, is will transfer the problem from the market to out of the market exceptional dispatch instructions because the operators are not going to go to real time unprepared. So that's
okay. So then that gets to my next question. Can we quantify how much of this how much we think this will cover the exceptional dispatches? So if we take sort of the size of exceptional dispatch and rec adjustments, we can look at how much of that was to a 95th percentile of those differences and see if that's going to, is that going to put them within their comfort range most of the time? I understand that, predicting what operators are going to feel they need to do is difficult. We don't know exactly what they're going to do. But it would give me some more comfort if you could show, because I think you probably have the data, if you could show some kind of metrics about how this would compare to exceptional dispatches and rec adjustments.
So I think the last column here, which is the adjusted forecast, has to a certain extent that effect because the adjustment is really the bias. So it is the operator action. So you can see where the uncertainty comes with the adjustment based to what the market is doing, which is the second column. Maybe you can articulate that.
Well, you're looking at like a statistical value of that, but on a day-to-day basis. I mean, I'm sure there have been times where the adjustment was bigger than what cleared in the market, right? In terms of the difference between the adjusted forecast and FMM. So on the occasion, and I'm also sure it's true that a lot of the times that there's a difference between the adjusted forecast and the forecast, that doesn't necessarily mean there's any difference in costs to the market, right? A lot of times those probably come for free or close to free. But it would be interesting to see, for individual realizations where there were large amounts of exceptional dispatches or there were significant costs in exceptional dispatch, would a 95% confidence interval from this kind of distribution actually cover what was procured?
One thing that I think would help just on the data we've already done is we're going to be presenting 4 case studies. Don will go over those during the discussion, but in the appendix of this presentation, we have the uncertainty that materialized for all of those case studies on a day-by-day, hour-by-hour basis. So I think that this just shows that distribution at the 95th percentile, but in my mind, that helped to see on like a weird abnormal day how much uncertainty actually showed up for a specific hour. And there is also, I know we published some data. I'm not trying to put off your comments. I hear you, and that's something we can discuss. I think we do have the data for that, but there is data that was published in the price performance analysis report that the MQRI team Guillermo's group, and it showed at least quantified the number of the operator bias in the day-ahead time frame. Just as a couple other reference points.
Paul Brivik, PG&E. I guess I don't find this very convincing that this is the optimal level. You're giving data that says, okay, this is a 95% confidence interval on average in the year. There's nothing that shows that the costs of carrying this amount of reserves is commensurate with the benefit you get from carrying these reserves. So there's nothing that shows that this is optimal. And I really don't find calling on hypothesis testing in the usual 5% very convincing in this situation. This is not a hypothesis test. So I don't really see that this is supporting a decision to go with 95%. I would like to see more on this because as it is, why not 93%? Why not 92%? It's a number. And just because hypothesis test that's the usual doesn't mean that's optimal. So just my comment.
Yes. Well, so I take your point. One point to note is that for the flexible ramping product, in the real-time market, we procure at the 95% confidence level. So I'm just saying that's what CAISO has done in the past. And so the idea is we could start there for this imbalance reserve. It's an open discussion what is the
I would like
right
to respond
amount.
to that very quickly. Mm-hmm. The 95% confidence level is the cap on what you procure. You use a demand curve. So it's to say you're procuring 95% in the real time is incorrect.
So Paul, this is Don. So in terms of like the additional analysis you would look for to see whether 95% is right, is it really those tail events, are they sustained like through the entire day? Like they just happen once and so in that instance you wouldn't need to carry that all the time because you probably have to go exceptionally dispatch to get it on, but
I'm not saying I need to carry all the time. I'm saying why is 95% correct? Why isn't 90% correct? There's nothing here that shows me a cost-benefit analysis.
So I think at the very least, these distributions show you if we were to procure at the 90th level, what amount of megawatts would that be based on an annual basis. So this is just showing you the full distribution. Historically, for 2018, this is what the full distribution of uncertainty that materialized actually was. And so it is an open discussion at what level of procurement are we comfortable with in terms of carrying those costs on a daily basis. And then also, if our goal is reliability, what is the amount of the worst case scenario do we need to be ready for? And so if, CAISO operators are comfortable with coming into the real time knowing they only have 90% of uncertainty covered, and if you guys are comfortable with then maybe 10% of the time those exceptional dispatch cover that remaining potential uncertainty, then that's an open discussion. So these slides really just show you historically what is the distribution of uncertainty, how much are we talking about, because stakeholders have asked how big of a problem is this, what is the number of uncertainty, is this a 20 megawatt problem or is it a 4,000 megawatt problem? So this is just what this shows historically has been the distribution. Sorry. Lindsay Schleck with NV Energy. So one of the things, I guess, so I wanted to backtrack a bit. One of the things I think about with this is that you have the day-ahead market and then you have stock, FMM, and RTD, and that is all to handle some of this uncertainties to some level. And so we've come to a situation now where we have a lot of load biases and a lot of exceptional dispatches to where you're saying that the market can't handle it. So what year in time or when in time did that kind of diverge? Have you looked at the past of how much the market can really handle to where you're comfortable with the amount of load biases and exceptional dispatches that were occurring? So I don't know. I mean, it's just kind of a question. Is that a way to kind of look at, if you go further back in history, to kind of determine how much this should really cover versus
I don't know, at like instead of like a 95 percentile? Just kind of a thought.
And again, I will say that from 2017 to 2018, the rec adjustment went from 2 to 3% of the time to 17% of the time. So it just shows you, even in 1 year, how much more operators are biasing. And so we could look back further, but for this analysis, we only did 2017 to first quarter of 2019.
But I think it's also important to remember what the purpose of the imbalance reserve product is. It's to ensure, through a market mechanism, that we have sufficient ramp capability scheduled day ahead with a real-time must-offer obligation so that we can then use those resources in stock, FMM, RTD to solve the differences that materialize. So I think it's just it's a recognition that the amount of uncertainty has increased, and I also think that if you look at the extended day-ahead market, there is no product in the West that says one balancing authority area will cover the imbalance needs of another balancing authority area unless you had a pseudo-tie or a dynamic schedule. And so this product actually allows you to now, in essence, transact that between the balancing authority areas so that you could actually serve someone else's imbalance versus just your own.
So another thing that occurs to me as I'm looking at this, so this is an annual number, right? And we're talking about using these numbers to talk about why we'd want to procure to P90 to 95th percentile.
This is just showing you the full distribution of that year. Subsequently, we also know there's a seasonal trend, and so in the appendix, I have these same distributions broken out by quarter, so you can also see. So this is really just to give you an idea of if we did only do the 90th percentile, how much would that be, and then how much of the historical uncertainty would be left uncovered. So it's a question of, are you as market participants and are you as operators comfortable moving forward carrying and not covering a potential 1,000 megawatts of uncertainty, historical uncertainty that you're not covering with this product. So it's a question of what balancing the, again.
But so here's where I'm going. You know, you talk about some of the uncertainty being predictable. There are quarterly trends. There are, even within a day, there are hourly trends, right? Presumably, we'd want to use some of that information to set a requirement for an individual hour. So this then is going to be kind of, you know, not as relevant because we're going to have a completely different distribution, or not.
It's not a different distribution.
This is unconditional, so we're going to have a conditional distribution of errors that will be significantly different than this for potentially each day and each hour, right? Okay.
So we do have a question on the phone. We'll go ahead and take it now.
Hi, it's Mark Coleman with PowerX. A few thoughts. First of all, I thought this analysis was very valuable in terms of at least seeing the data, what it looks like. But a few thoughts. First of all, I think we really need to think about what the adjustments to forecasts are. And I think it was well said earlier, I think it was Megan who described it this morning, is that what I understand operators are doing is they're adjusting the load forecast, whether that's in the ROC or in the HASP or in the FMM process, or they're exceptionally dispatching, not to try to get to expected load, but to create upward or downward headroom. So I think while the FMM to market and the FMM to forecast are good data numbers, we shouldn't be measuring adjustments to load forecasts that are trying to create flexible capacity reserves as to, well, was that adjustment correct or how accurate was it relative to actual load, because it's not what they're trying to achieve. It would be like saying in my example, if we have 40,000 megawatts of load day ahead and 2,500 megawatts of reserves for contingencies, was 42,500 a good load forecast? No, it's not, because the load forecast was 40, but 2,500 was carried for contingency reserves. So I think we're missing something here, in an inconsistency here on what the adjustments to forecasts are. And I see that in the data analysis that's at the end of the day as well. And again, I think it's great data. it's insightful, but I think there's an inconsistency here. Just because reserves are not deployed does not mean it was an inaccurate or inefficient solution. The operators are trying to cover balancing reserves to cover VAR and load movement. Now, if we have 2,500 megawatts of contingency reserves and we don't have a contingency event, do we say that's an inefficiency that we overcommitted units for contingency reserves when after the fact we didn't need them? We don't look at it that way, and appropriately so. So I think we really need to think about what these adjustments are, because I think it was described well this morning. These adjustments are currently being used to create imbalance reserves or capacity, not energy. And the second point is I agree with Paul Gribbick, we really can't look at these numbers in the way that it's being described. I think it's helpful to get an order of magnitude, and I take Tyso's point. I think that's important. But we need to remember, again, why the operators are doing this. There may not be any load adjustment some hours because the operator's looking and he sees an adequate supply stack on the ink side and on the deck side, doesn't feel like he needs to do anything in order to create that headroom. In other hours, like we see from the load biasing in the HAS process, we see in the evening peak very sizable positive load biases. That's not because they think the load's going to be higher, as I understand it, but it's because they don't see a big, deep supply stack left to be dispatched in case load comes in high or VARs fall off. So they increase the load bias to create that headroom. And so we really need to think about the adjustments to load forecast differently. In terms of the magnitude and how we should procure that, we agree with Paul Gribbick that this should probably be a demand curve, and what Mike said at the CPUC, this should probably be a demand curve, and actually it dovetails nicely into the discussion on scarcity pricing and the operating reserve demand curve that we've seen in other markets, which is really applying scarcity pricing and having the demand price rise the more deficient you are of these reserves. This seems to be an ideal product for applying an operating reserve demand curve that maybe you're buying much less than 97.5 when prices are $500 or $1,000 for these reserves, but when prices are $10, maybe you're buying right up to 97.5 or whatever that level may be. And so I think it does need a demand curve. I think it ties in with scarcity pricing and the concept of an operating reserve demand curve. And then finally, I'll just point out that, again, from the discussion this morning on an EDAM, this can't just be a discussion about the CAISO BA as an EDAM gets launched. Some BAs may be procuring to a 99 or a 99.5. Other BAs may be procuring to a 90% and deciding that they would rather use other actions or take on a greater amount reliability risk than maybe other BAs are comfortable with. I think that you're going to have diverse BAs across the West, and we need to come to, in an EDAM stakeholder process, what is the appropriate middle ground for an acceptable level of EDAM footprint-wide imbalance reserves to maintain reliability, and what does the structure of a demand curve that incorporates scarcity pricing into it for the level of imbalance reserves day ahead, and also for the real-time imbalance reserve product to make sure that we're doing that efficiently as well. Thanks.
Okay, so I want to move on to capture the seasonal variation because, as was pointed out, hourly is just one way to measure this, but we actually observe a significant seasonal trend. And I broke these out by month, and they happen to coincide with the quarters. And so for simplicity's sake, I just compiled it on a quarterly basis so you can see the general trends that happen seasonally. So Q1, and again, this is for Q1 includes 3 years of data. The other quarters include only 2 years. So for Q1, you see, again, that the market uncertainty is larger than what is materializing from the forecast, both adjusted and unadjusted, ranging from 3,100 megawatts of up for the market and 2,900 megawatts down for the market compared to 2,600 for the up for the forecast uncertainty and around 2,000 down for the forecast uncertainty. Moving to quarter two, you can see a large spike in downward uncertainty from the market, which increases to 4,200 megawatts of downward uncertainty, and a similar level of upward uncertainty. Looking at quarter two, which is your summer months, you see a growth in uncertainty up across
especially for the market uncertainty. And then your Q4 looks similar to your Q1. So this is indicating that uncertainty isn't the same across the year. And so, again, just using a yearly histogram is probably not the best measure, that we want to somehow scale this requirement based on seasonal conditions. And so this is kind of showing you historically what has the pattern been seasonally. And in the appendix, I also provide the full distribution broken out by quarter if you want to see values outside of the 95th percentile band. Any questions? Okay. So in addition to a seasonal trend, we also find an hourly trend. So this is for the year 2017. It's the distribution of uncertainty across the operating hours. And so these are a box and whisker plot. And so the boxes represent the middle 50th distribution. And so the top line of the box is the 25th percentile. The line in the middle of the box is the 50th percentile, the median. And then the bottom bar of the box is the 75th percentile. The whiskers are either the min and max of that distribution, or if there's outliers, which are the dots, then that bar is 1.5 times the IQR, which is the middle 50% of the distribution. And so what you can see here for 2017 is that the distribution within the across operating hours is fairly consistent. I think 2018 is more illuminating in terms of actually seeing an hourly trend, so I'm going to move on to show you that. So this, again, is that same plot, but for 2018. And so what's important to kind of pay attention to is looking within hours. You can compare across the different day-ahead market uncertainties. And so for hour ending 19, if you compare the blue box whisker to, which is the market uncertainty, to the red and the green, you can see that for hour ending 19, majority of the time the market overestimated what the real-time load would be because it has more uncertainty down compared to the forecast uncertainty. Additionally, I would pay attention to where the dots fall, because again, those are the outlier conditions, the worst case scenario. And so we can see that, at least for the market, we tend to have more outlier conditions on our evening ramp and a little bit in the morning ramp, and that the spread of that distribution is larger in the market than what was observed for the forecast, which is kind of fitting what we expected. Additionally, if you compare the amount of uncertainty that might materialize at, say, hour ending 7 versus hour ending 19, that band of that distribution is also going to be different. And so, to your point, we would probably want to scale this imbalance reserve not only on a seasonal trend, but also on hourly trend, because the amount of uncertainty that can materialize in the middle of the night is very different than what can materialize in the middle of the day due to the VERS that are on the system or how loads change over the operating hour as well. So these kind of show you, again, this hourly trend and how that's changed over time. And so, again, this also shows you that this problem is getting worse because the bands of the distribution are getting larger. If you compare 2017, they're roughly between 5,000 up and 5,000 down. In 2018, your outliers can get close to 8,000 up and about 6,000 down. So again, just the bandwidth of uncertainty by hour is increasing over time. So this is the first quarter of 2019. I think it's easier, again, to see the morning and the evening ramps and how the uncertainty is larger during those periods in terms of the size of the distribution. Any questions on the hourly trends?
Good question. Did you look into the which factor caused this uncertainty, become worse?
Yeah. So next, I present some quantile regressions that then tested to see if the observed trends are actually meaningful, or is this random variation? And so I will cover that next. Okay, so again, the tables that we've seen and we've seen so far are really descriptive, and so it kind of shows you some clues into what uncertainty has been and some patterns. But just looking at those, there's no way to know if, say, the difference in hour ending 19, if the distribution for the market uncertainty is really that different from the distribution of the forecast uncertainty. This could just be random variation in the data. So you need an extra test to confirm that that actually is a meaningful difference between those two factors. And that, yes, there actually has been a significant increase in uncertainty by year, by hour, by season. And so in order to do that, we ran quantile regressions, which allow you to estimate those effects at your worst case scenario of your distribution. So rather than fitting your parameters to that, trying to find the conditional means and the effect of these factors on producing conditional means, quantile regression allows you to look at how do those factors impact that worst case scenario day. So at the 95th percentile distribution, what is the impact of those factors in fitting that line? And so, not to overwhelm you with numbers, but the regression results are presented in the appendix if you want to see the actual numbers and level of significance. But just sort of from a qualitative perspective and what those regression results told us is that it demonstrated that there is a significant yearly trend, there is a significant hourly trend, and then in order to test the seasonal trend, we used hourly temperature in key weather stations that capture the differences between inland and coastal conditions in northern and southern California. And so this is not to say that we would scale the requirement necessarily to what the temperature was in San Jose, but rather to test since temperature correlates with month and season, then if there was like using that as a proxy for the seasonal trend. And so in the regression results, it shows that depending on what the hourly conditions of actual temperature are, that has a relationship to the amount of uncertainty that materialize. And so we know in talking with forecasting that, say, if the coast heats up unexpectedly, then uncertainty is larger than, say, when the inland counties heat up, because those folks are used to it, so they don't change their energy consumption. It's more predictable than what happens when the coast heats up. So again, these results just sort of both demonstrate in a more robust manner that, yes, historical uncertainty has increased over time. There is an hourly trend. There is a seasonal variation. And so moving forward, when we're determining our imbalance reserve requirement, we would probably want to scale it based on some combination of these factors, or we can have a better idea of when we're going to experience more or less uncertainty, because there is a relationship between, uncertainty increases when we have cloud cover come through and behind the meter solar doesn't come in as expected, or if, a heat wave comes in on the coast unexpectedly, then that's also going to lead to more or less uncertainty, as well as within the operating hour. Again, system conditions are different, and so we can use historical results to sort of predict what we think the bandwidth of uncertainty might be based on how the grid and net load responded to those conditions in the past. Any questions? Okay. Well, I think we want to move on to our discussion of pros and cons, so I'll hand it over to Don.
One thing real quick, Eric put over to Bonneville. We requested a lot more data in our comments, and I just wanted to thank the ISO for providing lots of data. And just picking up on a point Mark made, just really quickly, we'll get to Don. we've studied this issue with our own balancing authority, our own operations, and I know you just meant this as a discussion. There isn't a right confidence level, and that's how we approached it too. We see very similar uncertainty amounts like you do, and so I really appreciate that discussion. I will say that Bonneville does probably have a higher confidence level than a 95%, so that does have implications moving forward into any potential, future day-ahead ramifications of an EDM. Thanks.
Thanks.
Okay, good afternoon, everybody. So what we wanted to do here is, if you remember in the last technical workshop, we had mentioned that we wanted to review at the upcoming Market Surveillance Committee meeting to have one of the MSC members walk through their pros and cons of the two various options, but we wanted to all discuss it amongst ourselves first before we have that meeting. That meeting is on next Monday, and Scott Harvey will walk through and have a presentation on his views of the two options as well. So this is really just for us to have an initial discussion on what we believe the pros and cons are of the two approaches. I think we've already touched on quite a few of them already in some of the discussions, and so, but I do hope that there's lots of people expressing their opinions on this matter. So as we highlighted before, there's the two options, the financial and the financial plus the forecast. I think the key thing I would note on the, one second, I'm going to get my glasses. Sorry about that, I'm getting old, just turned 50. So on the financial one, I think it's important to note that we would make the requirement really based upon the difference between what the market, the error associated with the market clearing, and then for the financial plus the forecast, it's really the requirement is derived from basically the ISO's reliability forecast error. And so both of the options will co-optimize the ancillary services, the bid-in demand, and the imbalance reserves, with option 2 also adding in the reliability energy. So as we see, the financial, I just put the various constraints in. Boy, George. So the financial ones, we can see there's a power balance constraint for the energy, and then a requirement for both the up and down imbalance reserve requirement. If you move to the option 2 approach, you add an additional power balance constraint for the reliability energy, where the financial energy plus your reliability capacity up minus your reliability capacity down is cleared. And that's what gives rise really to the main differences between the two is the amount that you quantify for the imbalance reserve requirement, as well as the fact that you've added this additional energy product in option 2. And as with these new reliability capacity, we'd actually clear those at using the same imbalance reserve bids, basically the price at which you expressed your willingness to be available for redispatch in real time. And then again, the settlement for the financial, you settle the supply and the demand and the imbalance reserves, and then in the financial plus the forecast is the additional settlement of the reliability energy. And as a result of that, when you look at a specific resource, for example, if it's cleared consistent to its energy bid in the day-ahead time frame, you have to look at both its financial energy schedule as well as any overlapping reliability energy. So let's move into the pros and cons. So we'll talk first about the financial. First is by adding this new product, we'll have additional unit commitment and be able to position resources to meet upward and downward uncertainty. We would allow, LSCs are still able to procure a day-ahead position based upon their bids, energy bids. And the imbalance reserve need or requirement is really driven on historically how the market's got it right or wrong. And so if the market gets it more right, then the imbalance reserve will have a lower requirement. If the market gets it wrong and has a large error, then you'd actually increase the amount of imbalance reserves that you would need to do. So there's a stronger cost causation to addressing the behavioral changes that Mike actually highlighted earlier. In terms of the cons, one is, we've all talked about how we want to be able to scale the requirement, and as Bridget's data showed, you want to identify those factors, and we think that load, the amount of load that's forecast to be on the system, the amount of wind, the amount of solar that's forecast on the system, you could use those forecasts to scale the requirement. Well, unfortunately, with the financial approach, you really don't have a forecast to use as input data because you're basically requiring, you'd have to come up with some way to forecast how many virtual bids would clear. There also isn't the 100% guarantee that the energy and the imbalance reserves will cover the difference between the ISO's net load and the cleared net load. So again, we're doing the zonal procurement of the imbalance reserves, so that difference between what the CAISO's reliability forecast is and the what clears the market is only as deliverable as the imbalance reserves are on a zonal basis. So with that, I'll pause and see if anybody else, I know Mark brought one up with regards to the virtuals, Mark Holman, so I thought, see if we can have some other people identify some as well. Okay, we'll go to the phone.
So Lauren, we'll go ahead and take the questions on the phone, please.
Good afternoon, Don. Good to hear from SC. Happy 50th. Hi, can you hear me?
Thanks.
Hey, good. I hope this wasn't your birthday present, but moving on to my question. So actually, going back to slide 50, and this is something we mentioned in our comments too. If you notice, your formulation shows that, or states, that the reliability capacity is basically virtual bids and reliability capacity are substitutes of each other. So what does the CAISO propose to do about that? Because that is a feasibility problem. It's basically an economic problem.
So the reliability capacity can't be met by a virtual.
If you add those constraints, if you add constraints 1 and 2, you can basically have a relation where you have virtuals substituting for, as long as the virtuals are in there and it's an equation, you will have virtual bids substituting for reliability capacity. Any combination of any of those constraints is considered by the authorization. Whether it's a computer or a human being, they're going to look at it, they're going to say the same thing, the same information in there.
So you can say that, this is George Angelidis, by the way, you can say that the reliability capacity, one of the reasons for having it is because you have virtual supply that clears the day-ahead market that is not present in that second equation when you try to meet the demand forecast, and you can say that the reliability capacity up really substitutes to a certain extent for virtual supply, but that's the intended effect. So do you see any problem with that?
Yeah, because essentially I'm not saying there's a problem with putting in your forecast. I'm saying there's a problem with having the virtual bids and the reliability capacity together. You can't have a formula. You have to leave one of them out, because if you put because all this is a system of linear equations, simultaneous equations, and if you put in any non-substitutable items in there, components in there, you will have a problem, a feasibility problem. You can have one or the other, you can't have both. So the formulation would have to change something.
Actually, we can have both here because they appear in different constraints. So you have different power balance equations, and they appear, virtual supply appears in the first one, whereas physical supply appears in both. So you can have both, and from the tests that we run and the simulations that we have done, we released a spreadsheet for participants to have a look at how the results are produced. We didn't really see a problem with that. I don't know if you have seen some specific problem, you can send it to us to analyze, but we haven't seen any problem.
George, that's what I'm saying. You can mathematically put it in, but it does not make sense, because as long as, okay, let's say you ignore constraints 3 and 4. Let's make it easy. You have 2 constraints only, 1 and 2. Any combination of these constraints is still the valid expression of the constraint. In fact, if I add 1 and 2 together, then you add the left-hand sides of both equations together, right-hand side of both equations together. I've actually come up with a less binding constraint, less stringent constraint, but it is still representing the same information. And that constraint is saying that on the left-hand side you have virtuals, right? You have the ENJ, and on the right-hand side you have the RCs. They're equating. They're substitutes of each other. Economically, this is not feasible. Mathematically, yes, I can come up with any solution. I didn't say you have a mathematical problem here, but you have an economic problem here. This is very much similar to the dual constraint issue, and Don may remember that one, where you had physicals and virtuals not being fungible. You cannot have this make any economic sense. That is the problem here. This is not allowable as far as economics is concerned.
Now, I believe you have something else in mind, but in this situation, this is making perfect sense. You have these 2 different constraints. You're saying if I had the constraint that I add the 2 and I enforce the sum of those, then that's a different kind of constraint. And if you had all 3, you will say you have a redundant formulation, but these constraints are not related. They're literally 2 different constraints that are enforced simultaneously. So then you have different variables participating in those 2 constraints. So I don't see any problem, not only mathematically but also financially. We did show how the settlement would work for the variables that clear in this formulation, the financial energy and the reliability schedule. We didn't see any problem, but you know, if you have something concrete to show us, an example that you see a problem, we will analyze it. We're happy to analyze, but we haven't seen any.
George, I'm just telling you this. Okay. I don't need to show you any mathematical scenario where this would be. It could be feasible in every situation. It doesn't matter. But I disagree with you in that these 2 constraints, if they're added, they still represent the same information that the optimization must use. It's less stringent because instead of satisfying 2 equations, now I'm having 1 equation satisfied. But it is the same mathematical information conveyed. Because otherwise you're saying that mathematical operations such as additions are invalid. No, they're perfectly valid. If I add equations 1 and 2 together, they will show that you're basically expressing capacity and virtual bids as substitutes of each other. You cannot do that. If you go back and look at the dual constraint issue that the CAISO worked on and found that there was no feasibility with that, that is the exact same thing. It's because you had the lines ATC and you had the physical bid satisfying based on the transfer capability, and then you had the virtual plus physical bid satisfying based on the line's capability. And you cannot have both of those equations together because the virtuals are causing a problem. It was the same thing as adding up those 2 constraints, and you still have a fungibility problem. Virtuals cannot substitute for physical. That's the same thing here. If you go back and look at the dual constraint scenario, it's the same, same problem going on here. It's an economic problem. It's not mathematical. I'm not saying there's a mathematical solving problem here. There's an economic problem here. You cannot ever have virtual bid substitute for reliability capacity. And if I add constraints 1 and 2, which I'm perfectly allowed to do, you will have that problem.
Well, the problem here is that you have a different formulation. If you add the 2 constraints and you enforce the combined constraint, you're solving a different problem. That's not the problem we want to solve. So it's a really different problem from the one that you have in mind with the dual constraint. This is, you really want to find a solution that simultaneously is feasible with both these constraints formulated separately. So that's a different setup than the one that you have in mind with the dual constraint, which was on the same intertie. This is a completely different scenario. I don't draw any similarity to that. Anyway, maybe we can take it offline.
Yeah, because I think we do want to focus on the pros and cons.
Yeah, we can move ahead, but the problem still stays. Thank you.
Callie.
This is Callie Wells with WPTF. So I don't know if this is exactly what the previous comment was getting to, but one thing that we did observe with regards to virtual supply and the reliability capacity is that if the market, for every megawatt of net virtual supply that the market clears, it has to then clear another megawatt of reliability capacity. So there is a trade-off being made there, and we haven't, thought through the economics and mathematical standpoint where we land, but it is something that we did observe and things that maybe it warrants some discussion on if that does make sense.
It depends, right? It depends how successful are the virtual supply in estimating where the demand forecast will be. So if the cleared load matches the demand forecast, then of course anything that clears as virtual supply, you need to replace it. And that's what you're saying. But it may be also a scenario where virtual supply can correctly estimate the difference between where the load is going to clear and where the demand forecast is going to be, and then you don't have to replace anything. Basically, the difference in the demand forecast it's the other way around, but you can have no requirement for reliability capacity if the virtuals get it right. So it really depends.
Yeah, it was just kind of one of the observations that we made when we were looking at these formulas. But another comment, and Dawn, if you want me to defer this until you're a slide later, let me know. When we're characterizing this formulation, you use dual constraints quite a bit in this previous conversation, and I feel like that's a more appropriate characterization of this problem. It's a single optimization.
Can we get the terminology right? They're not called dual constraints, because dual constraints mean different things in optimization, but these are really, let's say, additional constraints.
Two constraints in one.
The constraints are paired for two different scenarios, and they're simultaneously solved together.
Right, but that doesn't necessarily, when I think of co-optimizing all these products, that's different than what's being shown here. So I think this is, I would agree that this is a single optimization problem with two different constraints, but I would push back on saying that this co-optimizes all those products, including the reliability, because whenever you hit scarcity on the reliability portion of it, the scarcity pricing is not going to be reflected in financial energy. So it's just how, I think we need to be careful on how we're characterizing this and just assuming that because you have two constraints in here and they're being solved at the same time, that means that all these products are being co-optimized in the sense of actual true co-optimization.
Well, we did show in the examples that you have prices, marginal prices that are a lot higher in certain intervals than what the bids are for the product, which shows the strong coupling between the commodities because of ramp constraints and other constraints that are active. So that is a sign that tells you that all these products indeed are co-optimized.
Sorry, I guess where I'd push back is that they're related. I agree there can be situations where the prices might move together, but when you reach scarcity and the capacity, that does not guarantee that scarcity pricing will be reflected in the financial energy LMP. And to me, when I think of co-optimizing all these products, when you hit scarcity in one, all the product prices should go up together. And I guess that's where I kind of push back a little bit on that characterization.
That's not necessarily true, though. I mean, it depends on how the products are bound together. Co-optimized means you find the optimal solution across products, but that doesn't mean that they're all bound to each other. It depends what capacity constraints are in place. If capacity constraints are tight and relate every product, then you're true in what you're saying. But if there is surplus capacity, the products really separate, and having scarcity in one, that doesn't mean that you have scarcity in the other. I mean, we can play around with scenarios, but if you have one, I'd be happy to have a look at it.
Okay, let's go to the phone.
Hi, George. It's Marco.
Lauren, we'll go ahead and get it.
Hi there. Can we just back up one slide? I think it's really helpful. And by the way, George, I think I agree with you and don't agree with the caller from SCE. I think those are two separate constraints. Both need to be met. You cannot just add them in an optimization. So I agree with your point on two callers back. But if we can look at slide 49, I think this just, to set the stage, this kind of highlights our point. The first term is physical supply, ENIT, subscript IT. Virtual supply is ENJT. So two things. One, if we were to adopt this approach in the West for a West-wide EDAM, we would have virtual supply and virtual demand, not only determining the energy solution across the West, but this is the only constraint that also achieves the capacity solution. So unit commitment in the West would not just be determined by bid and demand or load-serving entities' forecast demand. I think both could use a legitimate load-serving entity or CAISO forecast for demand. This is going to have financial speculation in virtual supply and virtual demand determine entities' unit commitments across the West. So if you have 2,000 megawatts of net virtual supply, that could decrease the gas and unit commitment in Arizona, Nevada, Idaho, Washington, Oregon, not just in California, in the concept of an EDAM. The second point on this slide is the point I made earlier, which is if you procure 2,000 megawatts of IRU, imbalance reserve up, that may be entirely unwound in terms of capacity commitment under this formulation by virtual supply on a net basis being 2,000 megawatts of virtual supply. That your capacity commitment, because you only have one equation, and you treat virtual supply, capacity-backed resources like thermals and hydro and VARs all equivalent in this design. If we can go to option 2, which again we see as the only workable option, we did provide some input for an alternative formulation. So we agree with the direction you're going in with this, George, and we agree with your point on the previous call. That second constraint needs to be met regardless of what happens with the first constraint, and the only supply and demand in that second constraint is physical. It is really physical energy plus physical reliability capacity up minus physical reliability capacity down must meet the CAISO's P50 forecast. Now, our proposal was to modify that constraint, remove RCD, so energy physical plus reliability capacity up, plus the imbalance reserve up from the bottom equation, that is all of your capacity, needs to meet your P95 or whatever level we determine is the reliable level of demand. And the reason why that's beneficial is a fewfold. One is it allows substitution. Two, it allows that your imbalance reserve product can use a demand curve. If you end up buying a high level of imbalance reserve up because it's at a low cost, then you need less total capacity than if imbalance reserve up becomes scarce. You may need more physical energy or RCU, and it allows substitution that's a lot more efficient. So again, we submitted detailed comments and really support the direction you're going in, but we think that that second equation can and should be improved to be a capacity up equation that doesn't go to a P50 demand forecast, but goes to a P95. But that does not mean that it's necessarily going to cost more because you include the imbalance reserve up supply towards meeting that constraint. And we would like to have further dialogue on the alternative formulation in 2. In terms of pros and cons, we really do see option 1 as causing challenges for an EDAM, and we see option 1 as causing virtual bidding challenges where you'll either have systemic profits for virtual bids and or you will unwind capacity commitments and place them in the hands of virtuals when virtuals should really be playing a role on energy convergence, not capacity commitments. Thanks.
Okay. Are there any other comments on the phone?
Yeah, this is Tayo from Tommy Energy Solution again. Look at the list of page 50 and your page 28. I think they are not synced together. They are different meanings. For 20, look at here, the third equation and the fourth equation is all relative numbers. Basically, it's a upward or downward megawatts relative to the energy schedule. right? So look at this option 2, the IRU, it includes the RCU and extra, right?
No, in this formulation, so here what we're doing is we're separating the uncertainty in terms of, maybe I can say it, pure uncertainty with what the difference between where the financial market clears and the demand forecast clears, because you need additional levels of uncertainty beyond that point. I think that's what Mark was suggesting, that maybe you should go to a P95 demand. We'll talk about that some other point. But the separation of the product that you see in option 1 as all as imbalance reserve up, here is done, you still more or less procure the same capacity, but you do it in a more precise manner. You separate it into 2 parts. And you say, I have one part that is looking only at the uncertainty where the financial market clears with what's going to be the supply in the real time, and then you procure that regionally. And then the other part, which is a traditional rack capacity for addressing the difference between where the financial market clears and where the demand forecast is, you procure it nodally through these equations. So it's not, if you compare the sum of the two with what is procured as imbalance reserve up in option 1, then you're on the same ballpark. But here it's just a separation of the products because they're procured and constrained differently.
Yeah, I understand your point. Let's go back to page 28 or 27. We can look at the page. You can see what's the meaning in that page.
Was that the figure with the
yes,
envelope?
Yeah, in that page, I think, go back to, one more. And one more problem, we look at the option 1 first. When we look at the option 1, you see the green box. I think we say it in absolute value, which means the top is at that value. The bottom is at that value. It's not that value shift around, shift up or down. Yeah, basically because you want to cover the uncertainty. Basically, it's the real-time demand you need. So
yeah, we did explain that this is a relative capacity, so yes, it's relative to...
In that sense, basically, the green box, we put it in absolute value instead of relative value. Relative value means you can move around the cleared bid supply, right? But if it's absolute value, which means we're looking into future for upward the maximum demand and the minimum demand could be, right? So it's a different meaning for this.
Maybe we're saying the same thing. You're saying it's relative, and I'm also saying it's relative.
No, I say it's absolute. It should be absolute, not relative, because the real-time demand is not depend on where your bid is cleared.
So in option 1, you don't know, the demand forecast is not in the formulation, so of course it's relative because you don't have absolute metrics. You don't know where the financial market is going to clear.
But you have a California ISO forecast.
But it's not in option 1.
I know, but the value can come out from the forecast, right?
How? You're procuring additional capacity on top of where the market clears. That's a relative concept.
No, basically, you procure extra capacity to meet the real-time demand.
Right,
that's your purpose.
But you procure that capacity from what point? That's your relative point. From the point where the market clears.
Yeah, so that's why, when you do the formulation, you don't put let's go back to 50. Or
let me help. So I think you're just saying you should do a different formulation where you say the imbalance reserves up plus the cleared bid-in supply needs to hit this number.
Yes, exactly.
So this is what we did more than a year ago. In our first attempt to combine these problems, we did have that formulation that was coupling the imbalance reserve product with the energy, and we had an issue because we end up having capacity prices that reflect the energy bid price, so they were very high. and we had pricing issues that we didn't want to overturn the prices that you have today from a financial market with such a strong influence from a physical market. So we abandoned that approach because of that reason.
Yeah, I understand. Right. You try to avoid the connections between the financial solutions and the reliability requirement. But the problem is, what's the purpose you procure extra imbalance reserve? The purpose is that you have to make sure you have sufficient supply to meet your real-time demand.
So you're making an argument for option 2 then, because in option 2 we can do that.
No, it's in option 1.
But in option 1, the demand forecast is not a factor. In IFM today, the demand forecast means nothing. It's not used at all. So unless you're proposing a different kind of financial market, it all matters is the bids that clear the demand forecast is irrelevant.
That's fine, because I mean, what I say is the purpose you create this new product is to resolve your reliability issue, right? If you cannot resolve your reliability issue, why you create this product?
Well, again, you're making an argument for option 2 because option 2 can do that for you. In option 1, you don't know that the demand forecast is not part of your problem, it's not part of your problem solution, so all you have resort to is to solve the problem in terms of where the market clears, and then I will procure from the financial energy schedule up and down capacity. You can't have the demand forecast in this formulation until you go to option 2.
Yeah, George, this is Khalid from ISO. I think the question is why you are introducing option 1 at all. That probably is where most of the discussion is going.
That's what I was trying to understand. I think he's making an argument for option 2. Now, why we're introducing option 1? Because we have also pros and cons for option 1. I mean, it's still a viable option on the table. Some people think maybe it's not viable. We heard that from Mark Coleman. But this is a workshop, and we present both approaches to have a discussion.
And I think the key is we want people to make the decision with their eyes wide open versus, some other reason.
Yeah.
Okay.
I mean, just one more. Even like page 50, so even for option 2, so I think your formula still need to be changed to reflect that absolute quantity, right?
We did that more than a year ago. If you see earlier papers and spreadsheets that we released, I'm pretty sure it was more than a year ago. We had tried that. We did attempt. This was our first attempt.
So go back to page 50. When you look at these formulations, right? Please go back to page 50. Yeah. So when you look at these formulations, the formula number 3 and number 4, you see IRUIT and IRURR. They both should be, when you look at the IRU up, it should be an absolute value, right? Because we just talked about for the reliability reason.
That's only if you make the assumption that the ISO demand forecast is the correct way to go. We have moved from that point, and we made this formulation more flexible that says, I want this relative capacity being procured, but I don't know who has it right, the financial market or the ISO demand forecast, and we procure this capacity and we have additional capacity constraints that make sure that it doesn't matter who has it right, both outcomes are feasible. So this is a superior way to address this problem.
Okay.
And I think when you look at some of the different scenarios, you're going to see there's instances where the market is more right than the forecast, and this actually helps address that.
So if you don't trust ISO's forecast, the formula number 2 is meaningless, right?
It's not that we don't trust. You see, as scenario optimization, we want to have two scenarios covered by our procurement of the imbalanced reserve product. That doesn't mean that we don't have a trust in one scenario or in the other scenario. We want to make sure that irrespective of which scenario is true, the outcome is feasible. It's a little different concept.
Okay, that's fine.
Okay, let's go to the phone.
Lauren, do we have a question in the queue?
Yeah, this is Seth with DC Energy. One thing about some of the narrative I've heard about virtuals and systematic profits, wouldn't that behoove us to eliminate the out-of-market actions that the CAISO is performing that is believed to cause the ability for virtual bidders to make systematic profits? So in other words, it just seems like we're saying off with the product when all that we should be saying is let's eliminate the out-of-market actions that are being undertaken that are so-called making the product not efficient. So I don't understand that. If the problem is that out-of-market actions are being taken and that's what causes these systematic profits, then it would behoove us to eliminate the out-of-market actions.
Well, so I think that the issue is that if you do out-of-market actions that commit additional supply to PMIN, and the amount that you've committed to PMIN is more than your virtual supply, then you could see a situation where the real-time prices are going to be less than the day-ahead prices because you're not going as high up on the bid curve. But if the opposite was there, to where you committed resources to PMIN, but the actual demand came in higher than that, you'd go up higher up the bid curve and the virtuals would lose money.
Why not let the market work and defer those why not let the market work and defer those commitments that the ISO is making? It seems like you're obviating the market signals. And actually, if you do procure RUC, that cost is assigned to the virtuals. So it's sort of a false narrative to just say they're making systematic profits because it's causing RUC costs. Those costs are what is assigned to the virtuals for being short.
Yeah, I didn't make the argument that virtuals were making undue profits. So
okay,
just stating the fact that
they're willing to accept that at face value, so I'm surprised that no one's actually addressed that. Thank you.
Okay, is there any other questions on the phone? Okay. So now let's move forward to the pros and cons on option 2. So just like in the previous option, we do get additional unit commitment to meet both the upward and downward uncertainty. We also get the added benefit that that difference between the IFM cleared net load and the CAISO's net load forecast is transmission feasible. Just as basically the same thing we're able to ensure with our RUC process today. We also would include, since we're using the ISO's net load, we actually have forecasted values for wind, solar, and load. So it is more straightforward if we wanted to use those as factors to scale up and down the requirement based upon the amount of those forecasts. And then we do have virtual supply and physical supply settling at different prices, which reflects that they do have a different reliability capacity value. If we look at the cons, one is we've inserted the ISO into the financial market, and does that have some impact to how the load serving entities can establish their day-ahead financial positions? We'll also have virtual supply and physical supply settling at different prices, and that may have some unintended consequences. We also have the reliability energy for the variable energy resources. That's based on the ISO forecast. So now there's a settlement implication for the VERS given the ISO forecast. And is there unintended consequences with that? For example, since if you're a VER and the CAISO forecast is higher than what you cleared in the day-ahead market, then we would pay you reliability capacity up, but that could also be, it could be a positive or a negative price depending on the optimization. If you then forecasted higher than what the CAISO thought you were going to deliver, then we would give you, in essence, you'd have to buy some reliability or buy some reliability capacity down to cover that difference. And then lastly, there are different prices for the imbalance reserve because it's a 15-minute ramp product, and the reliability capacity, which is a 60-minute ramp product. But they really have basically the same real-time must-offer obligation. So that's the pros and cons we came up on this one, and we're opening it up to others' comments on it.
This is Callie Wells with WPTF. So, Don, I guess I would add one, maybe two more to this con list. And I think the first one, your second bullet point when you talk about virtual supply and physical supply settling at different prices, might get to it. But I guess a bigger picture question that we have is because you have this potential of difference in prices for a physical generator, let's say it bids 30, the energy price that gets at its node is 25, but then it gets $5 on the reliability, so you would say on the whole it's fine. It bid 30. Between the two products it's getting 30. But one of those prices is nodal. One of those prices is zonal. The reliability is zonal. So I guess our question is how does one look at a price when you add a nodal price and a zonal price together? I guess we're struggling with what does that mean?
Reliability is nodal. The reliability capacity is nodal.
Okay, so then I thought one of them was
imbalance reserve
is zonal.
That is regional.
Okay.
It's a pure capacity product. The reliability capacity is the manifestation of the remaining capacity at the node because it's subject to transmission constraints. So that's what Don said. You make sure that at least this piece of the capacity is transmission feasible.
Okay.
All right, and therefore it gets a nodal price. So you compare nodal with nodal.
Okay. I appreciate that correction. But I guess our point is still that with the ability for a generator to have a price, a financial price that is not fully its offer, that you have to add two prices together to make sure it's whole, what does that mean? I feel like it's almost undermining what a nodal price is supposed to reflect. And those nodal prices are used in all different kinds of studies and assessments when you're making investment, transmission, decisions. So I guess one thing that I don't know if it's a con or just something that we feel needs to be further discussed is how do we interpret that going forward? Because I feel like
it's not different than today. As I said earlier, it's not a new concept. This is exactly the same like today. The price of energy is one thing, and then you have the price of another commodity that adds up to your revenue. Same today. You have an energy price from the financial, from IFM, and then you have another payment for rack availability from rack, also nodal. There's no difference here. It's exactly the same thing.
The difference that we see is that financial price might not reflect the marginal energy offer at that location.
It's the result of an optimization problem, so of course it will.
Okay, but an example that I guess what we're struggling with is in that example where a resource offers them 30, it's cleared, but the financial price that's paid is only 25. It's not reflecting their marginal offer of 30. I get that you have to add the two together, but it's really just a bigger picture question is what does that financial price mean for that generator if it doesn't reflect the marginal offer? In a locational marginal price, if that LMP is not reflecting the marginal offer, what does that mean going forward?
It's because you have two commodities that are bound from the same capacity of the resource, so getting a little more of the other, you have to give up some of the other. So the two are bound together, and that's why the prices show that effect. The marginal price for energy is 25 because that's what it costs to serve one extra megawatt of load at that location.
But it also provided $5 worth of reliability capacity at that location.
So from I don't know, maybe we can elaborate, but I guess our question is if you're looking at that $25 LMP in my example, what does that mean if that wasn't the marginal offer of that resource at that location and these prices are used in all different studies and used in making different business decisions. It's just a shift in paradigm, and I think it needs to be further discussed so that everyone...
Okay. See what happens with regulation down, okay, because it's a similar effect. A resource must be scheduled higher to be able to provide regulation down, which has a price. And it may be scheduled at a point where its energy bid is higher than the LMP. Yet, you are taking that resource, and now you say, how come the LMP doesn't reflect the price that is bid? That is because there is an interaction with the energy schedule and the regulation down product. It's exactly the same thing you see here. It's nothing new. It's two commodities coupled together through binding constraints. In this case, in this example, is the capacity of the resource. In another example could be the ramp capability.
I guess we'll have to kind of agree to disagree, and we can elaborate more on the comments, but it's really just a bigger picture question. It's a shift in paradigm in what that price is reflecting and what it means in the pricing of things.
That's what I'm trying to say. It's not a shift in paradigm when the paradigm exists today.
Okay, next.
Leah Fisher, Seattle City Light. So my question was also on the implications and unintended consequences of virtual supply and physical supply settling at different prices. Callie raised some good questions and potential implications, but I'm just curious if you can elaborate on some of the unintended consequences you list, or you just have that statement, but if you can elaborate on that, that would be helpful.
So let's do that supply example for the generator. If it wanted to hedge for a potential outage, then it would bid potentially virtual demand at its node, but it's only to be settled at the $25 price relative, and not the full 30. So, and is that an issue with regards to hedging for physical supply, for example, for potential outages?
Could it hedge by not bidding its full capacity in the market?
If it was non-RA.
Mike Castellano, Energy Division. So one thing that I'm thinking about here is, I think one of the things Callie's getting at is that the individual financial LMP on any node is going to be meaningless, as is the individual capacity node on any LMP is also going to be meaningless. The sum of the two might mean something, but load isn't actually being charged the sum of the two immediately. Load is going to be charged the financial one, and I'm pretty sure you could have a scenario, you could put together a scenario where the financial LMP is going to be zero at plenty of places, despite generators being paid, $35, $40, whatever. And then, it creates a whole new signal that nobody's dealt with. It is more complicated. It's not the same thing. Whether it's the end of the world, I don't know, but we're jumping into this just saying, no, it's exactly the same thing, when in my eyes, it clearly is not. The allocation of costs of this reliability product basically could become the allocation of costs of load. So, I don't know, I guess you guys kind of have a plan for that right now, but if it deviates from how we allocate costs of load, then it becomes, then you have all kinds of complications in terms of behavioral aspects and some other things like that. And I think, the more I think about it, I think you could get a situation where these constraints, not always, but can be duplicative, where you're going to have, because the bids for the two products don't have to be separate. They're basically being procured together from a given generator, from the set of generation. Like I'm saying, the individual prices on each of those constraints aren't necessarily meaningful. You could have one more or less not binding at a cost and the other one binding, and I don't think it matters which one. There's no sort of preconceived idea that one will bind and the other won't, or that one will be more important than the other.
There are quality constraints, Mike, so that both bind all the time. And
sorry, George, bind with a positive shadow price or a non-zero shadow price.
Yes, I was going to get to your comment about the zero energy price. This is not different than when you run IFM today. IFM is not going to clear at the zero price. It's going to clear at a price, and then you have some additional price for the capacity. It's not different than that. I keep coming back to this example. It's not something extreme done here that we're not doing today.
No, it is, George, because the financial price that you've got up there, that financial constraint could be binding at a zero shadow price.
That means the bids are zero that clear.
No, it means a bid is zero that clears. And it could be that you can't release any of the capacity that's in that constraint because of the second constraint.
Make me that example, then we can talk.
Yeah, that's pretty easy.
I'd like to circle back to the question I asked at the very beginning, because we've gone through the whole thing. And I'm not looking for an answer now, but I would like to see something expounded on this in the next document. Everything I've seen here, you're looking at the IRU requirements, FRU, FRD. They're set based on the error or the uncertainty between the net load in IFM and the net load in FMM in an hour. So it looks like an hourly estimation of how much uncertainty do I see. Here, again, you bring back, you've always talked about you're going to do granularity, ramp difference within the hour. And here, again, you talk about prices for imbalance reserves, a 15-minute ramp. My question is, what is the requirement for 15-minute ramp? Are you assuming that all of the imbalance, the uncertainty has to be met within a 15-minute interval? That could vastly overstate what you need. Or are you just assuming that, if it's in 15 minutes, I don't have any other uncertainty in the rest of the hour? How do I know that I have enough to meet the hourly? So I would just like to see something talked about that, because from what I've seen so far, this is an open question in my mind. So I'm not looking for an answer now, because I don't want to hit you with something and demand something now. I'd like to just say, let's put it on the plate to explain something which I'm finding confusing.
Okay. So maybe I answered this before in another meeting that we had, but I think I made an analogy of what happens with the requirements that we calculate for uncertainty in FMM, and we're looking at uncertainty that historically materializes between FMM and the worst 5-minute dispatch under the 15-minute. So the analogy here is to look between uncertainty that materializes between hourly energy schedules in the day-ahead market and the worst 15-minute demand, net demand in FMM. So at least that's how I see it.
Well, again, what I'm worried about here is now if I'm saying I'm looking at the hour or the net load forecast I'm using in the day ahead, and you're saying now I'm looking at the worst 15-minute interval, am I not going to be overestimating the error that I'm going to see whenever I'm now trying to ramp this over the hour to meet the energy requirement? They seem to be out of sync to me. I understand what's being done in real time, but this seems to be a little different, particularly because you're doing this analysis on an hourly basis. I'm not sure if I'm explaining that very well, but whenever you're saying I'm going to make sure I have enough ramp to meet my delta in my schedule plus the imbalance reserve over an hour, that's one set of ramps. And then if I'm saying the imbalance reserve's got to be deployed within the 15-minute interval, it seems to me like there could be some double counting of ramp there. I'm just a little concerned about it. I think we tried to raise that issue in one of our comments. So again, I'm not looking for an answer now. I'd just like to see a little more exposition on it.
Okay, nothing on the queue? Okay. So next we walk through some various scenarios or case studies. And so what these charts show is the hourly market net load, the hourly net load forecast, the hourly adjusted net load forecast, and then what the actual FMM net load forecast was. And so you can see in this example, having the ISO's forecast in here, we got closer to what the actual FMM net load was. So we ended up, you would get a more efficient day-ahead unit commitment because we tried to commit, the CAISO forecast was higher and correctly called it. In this scenario, we actually see that the market got it pretty right and the adjusted net load forecast overcalled it even more. So if you actually had put the CAISO's load forecast in, you would have actually tried to buy more reliability capacity up than you actually ended up needing. So I think it's important to realize that when RUC happens, RUC is not always clearing above the IFM. And we actually went back and looked at it, and about 55% of the time RUC will clear above the IFM, but 45% of the time RUC actually clears lower than the IFM. This is an interesting one where in the belly of the duck, we can see that, yes, everyone missed this day pretty good because of the cloud cover, but the market actually was closer. So if you go down to the option 2 approach, you would actually have the CAISO forecast in there trying to, rather than commit additional physical supply, it would say, all else being equal, if I had a virtual supply or a physical supply at the same bid, I would want to schedule a virtual supply in this scenario, but limiting in load's ability to actually move the physical supply up there. And then the last one is one where the market came in wanting to buy significantly higher, for some reason, a very high day ahead, taking a very high day ahead position, and the CAISO's forecast got it right. And the question is, would we want to prevent or limit load's ability to schedule that much physical supply if that's what they intended to do? So I'll take any questions on those various scenarios, but I think the key point there is we have to realize that it's not always an incremental RUC decision. And so you will introduce that interaction, and then there are instances where the fact that the CAISO's view of the world is lower, that you would limit the load's ability to schedule more physical supply in certain scenarios. Mike.
So I think this is a good way to kind of look at the data and see how different things can fall. But then the one piece that's missing, and I mean, we can't really put it in there now, but it's just another thing to think about. So, this gives us an idea of where these different requirements or where our, different ideas in the day ahead fall compared to where they do in real time. But each of these different paradigms, whether we're procuring to the forecast or to the market in day ahead, are also going to have different implications of what the costs are for those imbalance reserves or whatever else we're talking about. For example, here, we'll need almost all imbalance reserves down, right? We'll need a lot, but it could be that the imbalance reserves down are basically, are pretty low cost because this is if everything's sitting at PMAX, maybe nobody's, and prices are high, nobody needs anything extra to be able to deck during the day. So that's just sort of, looking at all these requirement differences that we'd have if we go with the forecast versus the market, is that quantity piece that we're looking at today is one part of it, and then the cost that quantity would come at is not necessarily the same under these different paradigms. So that's another piece that we have to think about.
Anything on the phone? Oh, go ahead, Roger.
Roger Avalos, Department of Market Monitoring. I didn't really know where to put this in the presentation, but there's a couple things that DMM just wanted to point out. One is that for the last several years, the ISO the MSC and DMM have all pointed out there's a lot of non-deliverable FRP in real time currently. And it seems like if you're going to be procuring a lot of capacity and day ahead and it's not related, deliverable in real time, it seems like we're wasting a lot of money and effort and capacity. The other issue that I think...
Can I just run? So yeah. we agree with that, Roger, and that's why we are looking to improve the deliverability constraints around both the imbalance reserve product and the flexible ramping product. So
is that in real time as well?
Yeah.
Okay. Everything ideally you'd be locational instead of the zonal or sub-zone regions. The other issue is, I don't even remember back in the flex ramp constraint days where that was just in the RTPD and would procure all this capacity, but then there was no constraint in the RTD, and so the RTD just let it go at the first interval, and we had a bunch of capacity procured, but that wasn't actually held, so we weren't really achieving a lot because we just used all the fast stuff in the beginning. The current RTD or RTPD and RTD flex ramp products, they only look out one interval. I know there's more optimal observation, but like the capacity is for 15 minutes or 5 minutes basically. And if you're doing a day ahead product and it's trying to get this ramp, it's optimizing over the whole day and it's looking, can I meet, feasibility from my down to my up across, from the belly of the duct to the neck of the duct. It might say, oh, that's feasible. Then we roll into real time, and we're not keeping 3 hours of worth of ramping capacity. It doesn't see the uncertainty coming up, and we might be just getting rid of a lot of that fast ramping capacity in real time. So if we just have these shorter interval FRPs in real time, we might not be able to utilize our stuff to procure.
We do procure for every ramp in both FMM and RTD. We just settled the one from binding to advisory, but in the formulation of FMM and RTD, we do procure and reserve flexible ramp product for every ramp from every interval to the next.
Well, I think recent evidence suggests that that's not been sufficient this summer.
I thought your concern was that if we don't reserve for the other ramps and we only reserve for the first ramp, then it will be released in the future and you won't have it. But that's not the case. Every real-time market run procures the product for all intervals in the time horizon.
Right. So like, for example, if you're worried about this 3-hour, 4-hour ramps, from, going from the belly all the way up to the peak, net load, it seems like if that's a product that's valuable, one, you should probably price that. And two, I'm not sure if it's really working right now because we're seeing a lot of out-of-market actions specifically aimed at freeing up fast ramping capacity by moving slow ramping capacity now. So I'm not sure how that's being implemented in current FRP, but it doesn't seem to be working at holding that capacity available. Anyway, this is something to consider, more changes to the real-time product and the locationality as we're doing the day-ahead to make sure that we're not procuring a bunch of capacity which is going to have a big effect on the day-ahead market and then not really having it available in real time anyway.
So we agree with the deliverability and would want to have a similar approach in both the day-ahead and the real time for improving that. Okay, any other final questions or comments?
Lauren, do we have anybody in the queue? Oh, go ahead, Lindsay.
You're fine. Lindsay Schlickler with NV Energy. I was wondering, so you showed a lot of data on the uncertainty. I was wondering, were you planning on doing any further analysis regarding the other comments that other people made on the analysis that we wanted for the future in this initiative?
Still brainstorming. I think I've got an idea of how to quantify the magnitude of the ramping problem. So that is what we would tackle next. And I will have to go back and look, but I think the majority of the data requests to date were focusing on the magnitude of historical uncertainty and the magnitude of historical ramping shortages. Do you have anything specific?
Yeah, one of the things we were asking for was the availability, like how much is actually available between day ahead and real time, like what's actually showing up to kind of see, kind of have an idea of the magnitude that's already there and exists today so that we could really determine how that lines up with the uncertainty that you're seeing and really determine if that will, I guess, in our minds, if that would really reduce the exceptional dispatches and load forecasts. So that's one of the things we were thinking. But
and do you mean how much is available through like the RUC process or how much is being bid into the real time?
Being bid in.
Bid into RUC or real time?
Real time, sorry.
Real time. Okay.
Yeah.
We do have some data that we've been working on how much is bid into RUC and determining the difference between RA, RUC availability bids at $0 and non-RA at a non-zero price. So we do have some data on that we can work on putting out, and that's important to keep in mind, though, that we'll be getting rid of the $0 RUC availability bid. But yeah, we can look into real-time bids.
Okay, thank you.
Any questions in the queue? Okay, next steps. So as mentioned earlier, we are, this is going to be a topic at the next MSC meeting on the 19th, which is Monday, and Scott Harvey is going to be presenting his input on the pros and cons that were discussed today. We are asking for stakeholders to provide written comments on the workshop discussion, as well as the discussion at the MSC. We did put a comments template out on our website, so we're asking for your input on both options. Also list the pros and cons that you see. And then the straw proposal will target putting out September-October timeframe. There'll be another MSC meeting in October, so we'll present it there. Revised straw proposal November-December timeframe, and then draft final proposal February 2020. I know that at the last workshop we talked about kind of changing our process a little bit, where we're going to be starting to draft the tariff language as well as the DRS during the last phase of the initiative, kind of the draft final proposal phase. So that's what you see here. And then the plan is to go to the EIM governing body and ISO board in Q4 2020, and then file with FERC Q1 2021 with the target of implementing this in the fall of 2021. So are there any other questions? Anyone in the queue?
We do have a caller in queue.
Okay.
Hi, Christina. It's Jeff Spires from PowerX. Just a comment on the schedule here. Mark Holman mentioned earlier just some consideration of the EDAM stakeholder process that's likely to begin in the fall, and consideration of how to incorporate this into that process. So I think that's something that we're still hoping that the CAISO can give some thought to. But aside from that, I think we very much appreciate the discussion at this workshop and at the previous one. We think that obviously this is a very important topic, and it's clearly complex. There's a lot of detail that needs to be thought through. And so I think what we would appreciate is enough time between the various proposals that may come up in the fall or any future workshops that might get scheduled, just to allow for the stakeholders to contemplate what's come out of these discussions, as well as continuing to have our own dialogue amongst the stakeholders regarding not only the CAISO proposals that we discussed today, but alternative ideas that stakeholders have, including some of the alternatives that we proposed in our last written comments. I think we've had lots of good discussions with other stakeholders, and there's lots of interest in continuing to think about these topics. So we just want to make sure that we have adequate time to do that. And so hopefully as you flesh out some of these dates, we could just make sure there's enough time in between each round to allow for that type of discussion to occur.
Okay. I'll let Greg comment on that.
Yeah, thanks for that, Jeff. And, we do take, points on EDAM. I think once we have more certainty as to whether that's going forward, we'll be closely looking at, what makes most sense from a stakeholder process as to whether we wanted, to combine that effort with this effort. And, so all these dates are somewhat subject to change. This is just our outlook as to how, we're planning on moving forward now. But, as we get more information, and particularly, related to EDAM and whether that's, turns the feasibility assessment comes in as that, yeah, it's a go, then, I think that would make us, we'll go back and take another look at this and see what's the best process for moving forward.
Thanks, Craig. I appreciate that.
Any other questions? Okay, thank you, everyone. We look forward to your comments on the 27th. Thanks for attending. Appreciate it.
That concludes our conference. Thank you for using AT&T Event Conferencing Enhanced. You may now disconnect.